Hey guys, welcome back. In today's video, we are talking about the MOASS indicator, the AMC setup, the overpriced stocks, and many more in this video. First, we're taking a look at this. One of my core MOASS indicators equals reverse repo below 200 billion, under 45 participating members, family office margin calls begin. Below 35 members equals Debbie does default, and then below $100 billion, this is when big banky recalls equities that are linked to bad bets that are too big to fail. So the reverse repo is something that we've been paying close attention to on this channel. The reason why I'm focusing on it now more is because we finally dropped that number of $155 billion. So the number itself isn't something that is significant, but when you understand that right now we are getting ever so close and we're finally seeing that drastic decline in the reverse repo, everything that we've talked about in the past is starting to becoming more and more likely. One of the biggest things we know with the reverse repo is that it really begun when the whole situation began with AMC and GME, and we knew that it was because they needed to give institutions money to finance the short positions, to create synthetic shorts, and much more than that. And that's why we saw the whole reverse repo go all the way up to $2 trillion. Now, over the years, because of everything that's happened, because of the overall market conditions, the economy, we've seen it drop from 2 trillion to where we're at right now, $155 billion. So still bear in mind is that it's still, of course, going to fluctuate. It isn't just a streamline kind of going down with the reverse repo. It may start off Monday. We may see it at $200 billion, but the very fact that we're finally seeing it in the $100 billion range, and we could even be seeing it in below the sub 100 billion range, is something that is quite significant for us, because we know that that means there is less liquidity. That means there's going to be a bigger illiquidity issue. So overall, we're going to be seeing that these institutions, that these banks are going to be seeing problems with the capital very, very soon. And that's, of course, going to mess up many things. If they don't have easy access to capital, they will have to, like we've talked about here, of course, recall equities that are linked to bad bets. And that's exactly what's going to happen. If we do see by next week the reverse repo go to zero, which I'm not saying that it's for certain. Remember, like I said, it does go up and down. It's not just a straight line down. We have to understand that. But what we can see is that definitely the institutions that have made extremely risky bet, that relied on margin, that relied on capital in order to maintain these positions, are going to be struggling. So we're going to be seeing the sell-off of assets. We're going to be seeing the cover of certain positions. And again, what we talked about at the very, very end is, of course, the covering of AMC and GME shorts. And it's becoming more and more unlikely now as we see the reverse repo really getting depleted. Another thing you guys can see, German bank starts to cut US office loan exposure that caused bond turmoil. So again, another thing to really understand what's happening in the market, another thing to understand in terms of the volatility, the illiquidity issues that's happening. One thing you will understand and you will realize is that I focus a lot on illiquidity, and that's because that's very important. The illiquidity problem essentially shows us the money that's flowing in the market, how the capital are tied up within each institutions, within the banks, within the hedge funds, because they are all very closely linked to each other, which are closely linked to the AMC and GME positions. And so that's why we pay attention to these things. That's what we have to understand, is that whilst we may think that something else is not related to AMC, it doesn't mean that it doesn't affect AMC or the short positions that is there, because one thing that's happening in a different market could affect the margin, could affect the capital of these institutions who are shorting AMC. And like we said, there is a lot more connections than you think within this industry. When you understand that there are some banks who don't short AMC, but they loan out billions of dollars to institutions who does, then you have to understand how that bank having lack of money would affect the short sellers. And again, vice versa. Like I said, there's a lot more connections we've gone through all in this channel. Is why we pay attention to other things that's not directly AMC related, but still has an impact on how we see the short sellers kind of proceed into the future. If we're going to be seeing them cover their positions, or are they going to be trying to find more loopholes? Furthermore, you can see AMC is still in a volatility squeeze setup. Nothing changed. The summer was the shading zone, September was the potential breakout. Now we are near the confirmed breakout. And so multiple things. First, you have to understand is that we obviously have the earnings coming up. Now, with what we've seen with IMAX, with what we've seen with Cinemark, we can obviously expect AMC to have a very good earnings. Now, one thing to note is that whilst we did see IMAX give good earnings and that they went up 10%, it doesn't mean that AMC will do the same. Because we know is that even when AMC does have good earnings, we're still going to be seeing the negative media articles that are pushed out, because their objective at the end of the day is to get people to stay away from AMC and to get people to sell their AMC shares. So what we have to understand is just looking at the fundamentals. We shouldn't be worried about what the price is reflecting, because we know that the price reflection isn't real. We know that there is no real price discovery for AMC, but the fundamentals is still important. Whilst it may not affect the price positively, as long as we understand that AMC is doing well in fundamentals, that's all we need. Because the biggest part we talked about this is understanding how short sellers are trapped in this play. The only two methods for them to get out of this whole situation is if A, every single retail investors sell their shares, or at least a large majority, 90-95% plus, or B, AMC goes bankrupt. Now, the first possibility of what we talked about, 90-95% or 100% of retail investors selling, very unlikely to happen. Now, in fact, I would say near impossible. The second thing is bankruptcy. Now, this is something that is still on the table in terms of there is a hint of possibility, but that then ties down to what we talked about, the fundamentals. Adam Aaron has already said for the next 2 years, we won't see any signs of bankruptcy. So we know that for the next 2 years, we're good. But it's going into the future, understanding is AMC able to operate, then that means what's happening right now is of course very relevant. And so that's why we have to understand with the fundamentals, are we going to be seeing AMC going bankrupt or not? That's why we have to pay close attention to the fundamentals and not what the price is reflecting. Furthermore, you can also see something like that's insane. This is insane. Warren Buffett is now building his cash balance at an unprecedented rate, even as the market hits new record. Berkshire Hathaway just announced that they are freezing buybacks and holding $325 billion of cash. What does Warren Buffett see here? Another thing to understand is that they have repurchased $0 of stock in Q3 of 2024. This compares to $345 million in Q2 of 2023 and $2 billion in each of the prior quarters. Berkshire said that it will buy stocks when Buffett believes that the repurchase price is below Berkshire's intrinsic value. So we can see in terms of what's happening in the whole overall market right now. We can see, like we talked about, Warren Buffett selling his Apple shares, Warren Buffett selling his Bank of America shares. Now, these two may not be the same reason, because we talked about selling Apple is because he thinks it's overpriced and he wants to free up cash. Selling Bank of America is because he doesn't feel like Bank of America is performing. So there's obviously differences. But one thing that is the same is that he is selling all these stocks to rack up on cash, to save the cash, because he's not using this cash anywhere else. He's not making any large purchases. And so what he believes is that the market is extremely overpriced right now. And one thing that we know is that after an overpriced market, it's bound for a massive market crash. So if what we are expecting in the very near future is for the market to crash, is for the market to have a 30, 40, or even more percentage correction, then what we can be seeing is massive assets value falling. It would mean that the banks who are trapped with their positions, with their derivatives, with trillions of derivatives positions, with their bad loans, with their over leveraged positions, and the same with hedge funds as well, all of these will see declines in their value. We'll see the mass selling, the fire sale of assets. We'll see how collaterals are going to be going to zero. We're going to be seeing margin calls happening. And all of that will mean that they will have less capital. And again, this ties up to what we talked about at the very start, the illiquidity problem. If we were to see the market crash, you guys can understand how an illiquidity issue will worsen and get even more serious. And that's why, what's to come right now, it's something that is very worrying for the overall market. But like we talked about, if we do see the collateral values of all of these firms dropping, then it means that we're one step closer to the squeeze. Now, furthermore, another thing is questions have long been raised about Nvidia, but it felt like few were listening until now. EY resigned while auditing SMCI and openly questioned the company's integrity and ethical values of one of Nvidia's biggest customers. So this is something that we've talked about. Now, first, what we understand is that Nvidia is one of the biggest reasons for why the overall market is going up. We know that it's bringing in tons of value because it's shot up all the way to $2 billion market cap, and of course, even higher, $2 trillion market cap and of course even higher. But one of the things we've always talked about is how overly inflated it is and how other firms rely on Nvidia's value going up because they are able to get a bigger collateral. They are able to get a bigger loan because of this. But now what you're seeing is that one of their biggest customers is potentially questioned for what happens to be, again, cooking up their own books. And again, if this was true, this will have massive damaging effects to Nvidia and will also have a massive effect on the market. So you guys can see there are many factors right now which are showing the market to be at a very, very bad state. And you guys, thanks for watching this video. I'll catch you guys next time.